Welcome to the Deep Dive, where we cut through the complexity and deliver the insights you need to be truly well-informed. Today, we're cracking the code on a topic that, well, it might seem a bit dry, but trust me, it's packed with strategic opportunities, business expenses. Not just what they are, but really how they can fundamentally reshape your bottom line.
It's exactly right. Our deep dive today, it's directly inspired by some foundational IRS guidance, specifically Publication 535. Our mission here is to sort of distill the most critical insights, helping you navigate what you can legitimately deduct, what you might need to capitalize, and, well, ultimately, how to be much more tax savvy with your business spending.
Yeah, think of it as your essential guide to smart deductions. It can put more money back in your pocket.
Precisely.
For any entrepreneur, whether you're just starting out or running an established business, getting a handle on your expenses isn't just about good bookkeeping, right? It's about building a powerful financial strategy. We're here to give you those crucial nuggets of knowledge, those aha moments that can directly impact your profitability and your tax bill. So let's unpack this.
Okay.
To kick us off, what exactly makes an expense deductible in the eyes of the IRS? I know we hear ordinary and necessary a lot, but what does that actually mean in practice?
Yeah, it's surprisingly straightforward, actually. For an expense to be deductible, it must be ordinary, and that just means it's common and accepted in your specific industry or, your type of business.
Okay, common and accepted.
Right. And it must be necessary, which just means it's helpful and appropriate for your business. Now, crucially, it doesn't have to be indispensable for your business to operate, just beneficial.
Helpful and appropriate, not indispensable. Got it.
But here's the key distinction, you see. Not every business cost is immediately deductible. Some are what we call capital expenses.
Capital expenses. Okay, can you break that down for us? What's the real difference between an immediate deduction and one of these capital expenses?
Sure. Think of it this way. When you capitalize an expense, it means you're treating a large purchase, like, say, a building or major equipment, or even a significant improvement as a long-term investment in your business.
Instead of just writing it off immediately.
Exactly. Instead of an immediate write-off, you then recover that cost bit by bit, usually over many years, through things like depreciation, amortization, or depletion.
So it's a strategic way to spread out the tax savings over time.
Precisely. It provides ongoing deductions rather than just one single upfront one.
That makes sense. Spreading it out can definitely be strategic, but, sometimes you really want that deduction now. Is there a way to deduct certain, maybe bigger ticket items immediately that might otherwise be capitalized?
Absolutely. And this is where the de minimis safe harbor for tangible property comes in. It's a really powerful tool, actually. Can put cash back in your pocket right away. Yeah, this allows many businesses to just expense smaller items instead of capitalizing them. So, for example, if you buy a new laptop, instead of depreciating it over, say, 5 years, you might be able to deduct the whole cost immediately.
Wow, that sounds like a big win for cash flow. What are the limits for that? Are there dollar amounts?
There are. It depends on your financial reporting. If your business has what's called an applicable financial statement, basically formal, often audited financial records, you can expense items costing up to $5,000 per invoice or per item.
5,000. Okay. And if you don't have those formal statements?
If you don't have an applicable financial statement, that limit drops to $2,500 per invoice or item.
Still pretty useful.
Definitely. And to take advantage of this, you simply make an election with your tax filing. It's actually much simpler to do than it sounds, and it's a direct route to immediate tax savings.
So that's a direct way to accelerate deductions. It sounds like the IRS really wants us to understand the difference between, investing in our business long-term versus just covering daily operating costs.
That's a good way to put it.
That also brings up the difference between improvements versus routine maintenance. How do we tell those apart for tax purposes? Because that seems tricky.
It can be, yeah. That's a crucial distinction. So generally, costs for improvements, things that significantly better a property or restore it or adapt it for a new use, like a full roof replacement or a major electrical overhaul, those are generally capitalized.
Makes sense. Big jobs.
Right. However, there's also something called the routine maintenance safe harbor that's incredibly useful.
Yeah.
This means you can deduct costs for recurring activities that just keep property in ordinary operating condition, even if they might otherwise seem like improvements.
So like regular upkeep.
Exactly. They just need to be for recurring activities. They have to arise from the property's use and, importantly, keep it in ordinary operating condition. So this provides another opportunity for those immediate deductions.
That's really good to know. Okay, and for businesses that sell products, cost of goods sold is fundamental. What exactly goes into that calculation for tax purposes?
Right, cost of goods sold, or COGS. It includes your direct costs like raw materials, freight in, storage, direct labor costs, and things like factory overhead. It's basically how you calculate your gross profit.
Okay.
Now, while there are typically complex uniform capitalization rules, often called unicap rules for production or resale activities, which often require you to capitalize certain costs rather than deducting them immediately.
Sounds complicated.
It can be. But there's a great small business taxpayer exception. If your average annual gross receipts for the 3 prior tax years are $27 million or less, and you're not classified as a tax shelter, you're generally exempt from these complex unicap rules.
27 million, that covers a lot of businesses.
It does, and it can significantly simplify your accounting and allow for more immediate expensing, which is great.
Yeah, that exception sounds like a real simplification for many listeners. Okay, let's shift gears a bit now to how you pay your team and cover your workspace. You can generally deduct employee pay wages, salaries, bonuses, fringe benefits, as long as it's, quote, reasonable and for services performed. What does reasonable really mean in the eyes of the IRS?
Well, the reasonableness test for employee pay is basically designed to ensure compensation isn't excessive, especially, for owners or related parties.
Right, prevent hiding profits as salary.
Exactly. The IRS looks at things like what similar businesses would pay for similar services. They consider duties, business volume, responsibility, time commitment, even cost of living, and the employee's specific abilities.
So it's a comparison test.
Pretty much. It's also worth noting for publicly held corporations, there's that $1 million compensation limit for certain covered employees.
Good point. Okay, beyond salaries, what kind of fringe benefits can businesses deduct? I imagine there are some surprising ones that can add up to significant savings.
Oh, absolutely. For example, employee achievement awards are deductible. These are for length of service or safety achievements. There are limits, though. $400 for non-qualified plan awards and $1,600 for all awards combined under a qualified plan.
Okay, so not huge amounts, but it adds up.
It does. And even simple gifts of nominal value, like, say, holiday turkeys or small merchandise gifts, can be deducted for employee goodwill.
Little things matter.
They do. And education expenses are deductible if they're part of a qualified educational assistance program. Now, here's a key point for listeners, a really important one. The CARES Act temporarily expanded this to include employer payments of employee student loans principal or interest.
Oh, wow, that's big.
It was. But crucially, this exclusion is set to expire on January 1st, 2026, unless Congress extends it. So definitely keep an eye on that if you're offering student loan assistance.
That's a really critical heads up. Good example of a temporary tax saving rule. Okay, what about meals and lodging? That's an area that always seems to have shifting rules.
It definitely does. Generally, you can deduct 50% of business meal expenses. 50%.
The standard rule.
Right. However, there was a temporary boost for food and beverages provided by a restaurant specifically and paid or incurred after December 31st, 2020. But before January 1st, 2023, it was actually 100% deductible.
Oh, I remember that. That was a nice perk.
It was. But now it's back to 50%. And it's crucial to remember, if food or beverages are purchased alongside entertainment, the entertainment portion itself is generally not deductible anymore.
Right, the rules got stricter on entertainment.
They did. And also, sort of on the flip side, transportation commuting benefits. Things like transit passes or parking paid for employees. Those paid or incurred after 2017 are no longer deductible by the employer.
Even though they can still be excluded from the employee's wages.
Exactly. The employee still gets the tax break, but the employer doesn't get the deduction. That's a point of confusion for many businesses.
That's a really good distinction to make. Okay, so when employees pay for business expenses out of their own pocket, how should businesses handle reimbursements for tax purposes? Are all reimbursements treated the same way?
No, they're not. And this raises an important question for employers. Are you using an accountable plan or a non-accountable plan for employee expense reimbursements? It makes a big difference.
Accountable versus non-accountable, okay.
Right. So under an accountable plan, the employee has to substantiate the expenses, provide receipts, and return any excess reimbursement they receive.
Makes sense.
When that's done correctly, the employer deducts the expense, and importantly, it's not treated as income to the employee.
Okay, win-win.
Pretty much. A non-accountable plan, however, treats those reimbursements essentially as wages. They get included on the employee's W-2 and are subject to payroll taxes.
Ah, so setting up an accountable plan is usually the better way to go.
Generally, yes. It could be a significant tax advantage for both the employer and the employee.
Good to know. Let's move on to the physical space of a business. Rent expense. What should our listeners know about deducting rent? Seems straightforward, but maybe not.
Mostly straightforward, but a few key things. Rent is generally deductible if it's for property used in your trade or business. And this is important. You don't gain equity or title in that property through the payments.
So a true lease, not a purchase in disguise.
Exactly. A common pitfall is unreasonable rent, especially if you're renting from, say, a family member or a related company. The IRS might disallow portions of it if it's significantly higher than fair market value.
Okay, keep it fair market.
Right. Another important point is prepaid rent. If you pay rent in advance, say for next year, you generally must capitalize it and deduct it only over the period it actually covers, not all at once when you pay it.
Spread it out.
Spread it out. And, as you hinted, payments under a conditional sales contract where it looks like a lease but it's really a purchase agreement, those aren't considered rent for tax purposes.
Right, and what about the costs of getting the lease itself, like broker fees?
Good question. If you pay commissions, bonuses, or fees to get a lease, those costs are generally capitalized and then amortized, meaning deducted evenly over the term of the lease. So if you pay, say, $10,000 to secure a 10-year lease, you typically deduct $1,000 each year for those 10 years.
That's helpful, especially for new businesses signing their first leases. Okay, now let's dive into that unavoidable trio for every business: interest, taxes, and insurance. Starting with interest, what are the rules for deducting business loan interest?
You can usually deduct business interest expense if you are legally liable for the debt, if you and the lender truly intend for the debt to be repaid, and if there's a genuine debtor-creditor relationship. Pretty standard stuff.
Okay.
But what's really crucial to understand about interest is how it's allocated for tax purposes. It's generally traced to how the loan proceeds are used, not necessarily what property secures the loan.
Oh, that's interesting. So the use of the money matters most.
Exactly. So, for example, if you secure a loan with some business property, but you actually use the funds to buy a personal car, that interest is considered personal interest, not business interest.
And therefore not deductible as a business expense.
Correct. That's a common misconception. Also, remember prepaid interest. Just like prepaid rent, you generally can't deduct it all in advance. You typically deduct it only as it accrues or becomes due.
Got it. Okay, shifting gears to taxes. What kind of taxes can businesses actually deduct? It feels like there are so many.
There are quite a few. You can deduct various federal, state, local, and even foreign taxes if they are directly attributable to your trade or business.
Okay, what are the big categories we can deduct?
You can deduct things like state and local real estate taxes on business property, unless they're assessments for local benefits that increase your property's value, like new sidewalks. You can deduct state and local income taxes, but only if they're directly tied to your trade or business income. For individuals, remember that state and local tax deduction is generally capped at $10,000 on Schedule A, but business-related state income taxes might be deductible elsewhere.
Okay, that's an important distinction. What else?
Employment taxes, the employer's share of FICA, Social Security and Medicare, IFUTA, federal unemployment tax. Also, federal excise taxes directly related to the business, state, and local sales taxes paid on business purchases, though these are often added to the cost basis of the asset rather than deducted separately. Franchise taxes, occupational taxes, and personal property taxes on business assets like equipment.
What about federal income tax itself?
No. You cannot deduct federal income taxes. Also, generally can't deduct estate and gift taxes or state inheritance or succession taxes.
Okay, good to clarify. What about sales tax again? You said add it to the basis.
Generally, yes. Sales tax on purchases is usually treated as part of the cost of the service or the property you bought. So if the property is something you depreciate, like a machine, you just add the sales tax to its cost basis and depreciate the total amount.
Makes sense. Any big tax-saving deduction related to taxes themselves?
Yes. For self-employed individuals, this is huge. You can deduct 1/2 of your self-employment tax. This is an above-the-line deduction on your Form 1040, meaning you don't have to itemize to take it. It directly reduces your adjusted gross income.
That self-employment tax deduction is definitely a big one.
It is. And just a quick reminder, remember those uniform capitalization rules we talked about? Sometimes taxes, like property taxes on a factory during construction, might need to be capitalized into the cost of the asset rather than being deducted currently.
Right, it keeps coming back to that capitalization concept. Okay, finally in this trio, let's talk insurance. What types of insurance premiums are deductible for a business?
Generally, the ordinary and necessary costs of insurance for your business are deductible, and this covers a pretty broad range.
Like what specifically?
Things like fire, storm, theft, accident insurance, credit insurance to cover potential bad debts, group hospitalization and medical insurance premiums you pay for your employees, including long-term care insurance.
Employer paid health insurance. Oh,
Right. Also, workers' compensation insurance, general liability insurance, professional malpractice insurance, often called errors and omissions, even overhead insurance that pays your business overhead expenses if you become disabled.
that's quite a list. Car insurance too.
Yes, the business use portion of your car and other vehicle insurance, and business interruption insurance, which covers lost profits if your business has to shut down due to something like a fire.
Okay. Now, for our self-employed listeners, is there a big one here like the self-employment tax deduction?
Absolutely. It's the self-employed health insurance deduction. This is a major tax-saving opportunity. If you're self-employed, you may be able to deduct the premiums you pay for medical, dental, and qualified long-term care insurance for yourself, your spouse, and your dependents.
And this is also an above-the-line deduction.
Yes, exactly. It's taken on Schedule 1 of Form 1040, so it directly reduces your adjusted gross income. This often saves you much more tax than if you were to try and itemize medical expenses on Schedule A.
Are there limitations?
There are. The deduction is limited by the net profit from your self-employment business. And crucially, you generally can't claim this deduction for any month where you are eligible to participate in an employer-subsidized health plan, like through a spouse's job.
Eligibility matters. But still, that sounds like a powerful way for many self-employed individuals to significantly reduce their tax burden.
It really is. It's one of those valuable deductions available to them.
Okay, that's a fantastic point for self-employed individuals to really look into. So we've covered the basics of what's deductible immediately and how some big purchases get capitalized over time. But you mentioned sometimes there's a strategic choice, deduct now or capitalize and recover later. This sounds like where truly smart tax planning comes in.
Indeed. This is where you get some flexibility. For example, carrying charges. These are things like taxes and interest you might pay while carrying or developing real property, or while transporting and installing personal property.
Yeah.
If these charges aren't subject to those mandatory uniform capitalization rules we discussed, and they would otherwise be deductible, you can elect to capitalize them instead.
Why would you choose to capitalize something you could deduct now?
Maybe you have low income or even a loss in the current year, so the immediate deduction isn't very valuable. By capitalizing, you add it to the basis of the property and potentially get larger depreciation deductions in future, more profitable years. It gives you strategic control over the timing of deductions.
Interesting. Okay, speaking of strategic choices, or maybe lack thereof now, let's talk about research and experimental costs. You mentioned there's been a significant shift here recently.
Yes, this is absolutely critical for any business involved in innovation, R&D. It's a major change. Previously, these R&E costs could often be fully deducted in the year you incurred them.
Which was great for cash flow for R&D heavy companies.
Exactly. However, for tax years beginning after December 31st, 2021, these research and experimental expenditures must now be capitalized.
Must be, no choice.
No choice anymore for deducting them immediately. They must be capitalized and then amortized or spread out ratably over a 5-year period for research conducted in the U.S. or over a much longer 15-year period for research conducted outside the U.S.
Wow, 5 years or 15 years instead of immediate. That's a huge difference.
It's a fundamental strategic hurdle. It's not just an accounting tweak. It means instead of getting that immediate tax break to offset the cost of innovation, you're spreading that deduction over a much longer time frame.
Which directly impacts your immediate cash flow.
Right.
Leaves less money for reinvestment.
Precisely. It makes funding ongoing R&D potentially more challenging from a cash flow perspective. It's a really significant change businesses need to plan for.
Definitely a major heads up for innovative companies. Okay, another area with an elective deduction, crucial for new businesses, is business startup and organizational costs.
Right. When you're starting a business, you incur costs before you even open your doors. The rules allow you to elect to deduct up to $5,000 of business startup costs and another $5,000 of organizational costs in the very year your active trade or business begins.
5,000 of each.
Yes. Any costs above those initial $5,000 amounts are then amortized over a 180-month period. which is 15 years.
So you get a nice little upfront deduction when cash flow is often tightest?
Exactly.
Mm-hmm.
And the important thing is this option exists, and electing it is fairly straightforward. Now, you generally don't need to file a separate statement. Just claim the deduction appropriately on your return. It provides significant upfront deductions right when you're getting started.
Good to know. And for those in the timber industry, you mentioned reforestation costs.
That's right. There was an election available here, too. You can elect to deduct up to $10,000 per year of qualifying reforestation costs per qualified timber property.
10,000.
And any remaining costs above that can be amortized over an 84-month period, which is 7 years. So again, a mix of immediate deduction and amortization.
And similar rules for accessibility improvements.
Yes, costs businesses incur to remove architectural or transportation barriers for people with disabilities or the elderly.
Yeah.
You can elect to deduct these costs up to a limit of $15,000 per year.
15,000.
Any costs you incur above that $15,000 limit aren't lost. They just get added to the property's basis and can be depreciated over time.
So multiple opportunities to elect immediate deductions versus spreading them out. Okay, so for all these capitalized costs that aren't immediately deducted, like the excess startup costs, the R&D, the intangibles, we recover them over time through what we call amortization. How does it work exactly? Is it just like depreciation?
It's very similar conceptually to depreciation, yes, but amortization is specifically for intangible assets, things you generally can't physically touch, like goodwill you acquire when buying another business, patents, copyrights, customer lists, franchises.
Intangibles? Okay.
You spread their cost out systematically over their useful life, or a period defined by the tax code. And you typically report this amortization expense on Form 4562, the same form used for depreciation.
Are there standard periods for amortization like with depreciation?
Yes, there are. A key category here is Section 197 intangibles. This covers a lot of the common ones acquired in a business purchase: goodwill, going concern value, workforce in place, customer-based intangibles, patents, copyrights, trademarks, licenses, non-compete agreements. These specific Section 197 intangibles are generally required to be amortized ratably over a 15-year period or 180 months.
15 years for things like goodwill. Okay, that makes sense. Let's quickly hit a few other common business expenses that our listeners might encounter, things that can lead to tax smartness if handled correctly. Advertising expenses.
Generally deductible, yes, as long as they're reasonable in amount and directly related to your business, promoting your products or services.
Okay. And car and truck expenses. We touched on this, but the methods.
Right, you have that choice. You can deduct your actual expenses, things like gas, oil, repairs, tires, insurance, registration fees, licenses, and depreciation or lease payments.
Keep lots of receipts.
You do. Or you can use the standard mileage rate, which simplifies record keeping. For 2022, remember those rates changed mid-year, 58.5 cents per mile from January through June, and then it jumped to 62.5 cents per mile from July through December due to higher gas prices.
Right. Got to use the right rate for the right period.
Exactly. And a key point for self-employed individuals. Regardless of whether you use the actual expense method or the standard mileage rate, you can also deduct the business portion of any interest paid on a car loan and any state and local personal property taxes paid on the vehicle.
Oh, that's an add-on benefit for self-employed. Good tip. What about internet-related expenses? Everyone has those now.
Generally deductible as an ordinary business expense. However, if you're setting up a website for a new business before it starts operating, those costs might be considered startup costs subject to those $5,000 deduction and amortization rules we discussed.
Ah, context matters.
Right.
And legal and professional fees, like paying accountants or lawyers.
Deductible, yes, if they are ordinary and necessary and directly related to operating your business. Think fees for tax advice, tax preparation for the business return, legal fees for drafting business contracts, or resolving business disputes.
But not for personal matters, right? Like a personal will or divorce?
Correct. Those are generally personal expenses and not deductible as business expenses, even if they tangentially involve business assets.
Okay. What about physically moving machinery?
The cost of moving your existing machinery from one city or plant to another is generally deductible as a current business expense.
Okay. But installing new machinery?
Installing newly purchased machinery is typically considered part of the cost of that new machinery and must be capitalized along with the machine's purchase price. That's a common point of confusion moving old versus installing new.
Good distinction. And repairs, like fixing things around the office or shop.
Yes. The cost of routine repairs and maintenance that keep your property in good operating condition but don't significantly add to its value or prolong its life are deductible. Things like repainting, fixing leaks, patching floors.
But you can't deduct the value of your own labor if you do the repair
That's
yourself.
right. Correct. Only the cost of materials and payments to third-party contractors. This is different from improvements, remember, which generally add value or adapt the property to a new use and are capitalized.
Right. Repairs deduct now, improvements capitalize. And utilities, heat, light, power.
The business portion of your utilities, heat, lights, power, water, telephone service, is deductible. If you have a dedicated second phone line just for your business, that's typically fully deductible.
What about the first phone line in your home, if you have a home office?
The basic local service charge for the first phone line into your residence is generally considered a non-deductible personal expense, even if you have a qualifying home office. Long-distance business calls on that line would be deductible, though.
Tricky rules around home phones. Okay, one area that I know can cause a lot of headaches, and definitely tax questions, is business bad debts. What are the key rules here?
Yeah, bad debts. This refers to amounts owed to your business that become uncollectible, usually from credit sales to customers or maybe loans you made for business reasons, like to a key supplier or client.
Okay, when can you deduct them?
Here's the crucial point, the absolute key. You can only claim a bad debt deduction if the amount you're writing off was previously included in your gross income.
Included in income first. Why is that?
It prevents you from getting a double benefit, essentially. If you never reported the amount as income in the first place, you can't then deduct it when you don't receive it. This primarily affects cash method taxpayers.
Because cash method folks only report income when they receive the cash.
Exactly. So if they make a sale on credit and the customer never pays, they never reported the income, so there's nothing to deduct as a bad debt. Accrual method taxpayers, on the other hand, report income when they earn it, even if they haven't been paid yet. So if that income becomes uncollectible, they can generally take a bad debt deduction because they already included it in income.
That's a really important nuance based on accounting method. Okay, finally, just a quick note on not-for-profit activities, often known as the hobby loss rules.
Right. This is about activities you engage in that might look like a business, but aren't really carried on with the intention of making a profit. Think hobbies that generate some revenue but consistently lose money.
So you can't use those losses to offset your other income, like from your job.
Generally, no. If the activity isn't engaged in for profit, you can usually only deduct expenses related to it up to the amount of income it generates. You can't claim a net loss to reduce your other taxable income.
How does the IRS determine if it's a business or a hobby?
They look at various factors, like whether you conduct the activity in a business-like manner, your expertise, the time and effort you put in, your history of income or losses, etc. But there's a helpful presumption of profit rule.
Oh.
If your activity shows a profit in at least 3 out of the last 5 consecutive tax years, or 2 out of the last 7 years for activities involving horses, the IRS will generally presume that you are engaged in it for profit.
So even if you have a loss in 1 year, if you meet that test, you can still deduct all your legitimate expenses.
Correct. Meeting that presumption shifts the burden of proof to the IRS if they want to challenge your profit motive. It really all comes down to your intent. Are you genuinely trying to make a profit?
Wow, that was a truly deep dive into business expenses. I mean, from the smallest office supplies all the way up to major capital investments. Really understanding these nuances is like having a powerful financial tool, sort of a secret weapon in your tax planning arsenal. It's clearly not just about what you spend, but like you said, how you categorize it when you deduct it. That makes all the difference to your actual bottom line.
Exactly. As we've explored, knowing whether an expense is ordinary and necessary for an immediate deduction, or if it needs to be capitalized and amortized over time, can significantly impact your taxable income year to year. The real key takeaway here has to be meticulous record keeping. You need the documents. And also, continually educating yourself on these rules because things do change, like that R&D rule. Proactive tax planning is truly the best tax-saving strategy.
Absolutely. And remember, these aren't just dry rules. They're actually opportunities. The ability to deduct something like the self-employed health insurance, or to strategically use those de minimis safe harbors, or elect to amortize startup costs that can put real money back in your pocket.
Yeah, tangible savings.
So what does this all mean for you, the listener? It means maybe taking another look at how your business tracks its spending. Are you taking advantage of those safe harbors? If you're involved in R&D, have you adjusted your planning for the new capitalization rules?
Right.
Think about how a deeper understanding of these concepts could free up resources, maybe for your next big business move, or just improve your cash flow. Knowledge truly is power. especially, it seems, when it comes to taxes.
Couldn't agree more. And for the latest, most current information and any future developments, because tax laws can and do change, always check the official source, irs.gov. You'll find publication 535 there, which we referenced quite a bit today. And they also have specific guidance centers, like the Gig Economy Tax Center at irs.gov gig, which is really useful. And of course, when in doubt, or if your situation is complex, seeking advice from a qualified tax professional is always a smart move. They can help ensure you're making the most tax-smart decisions for your unique situation.
Excellent advice. Well, thanks for joining us on The Deep Dive, and we certainly look forward to having you back for another journey into being better informed.